What's up, future traders? So today I'm going to show you the basics of how to trade options and give you the fundamentals that you'll need in order to be successful at trading. Now, if you're new to the channel, my name is Rashad. I am a full-time options trader and I bring in multiple six figures a year from trading options. And I use the money I make from the stock market in order to pay for my entire lifestyle. But I started trading during the pandemic out of necessity. And over the course of the next several years, I just kind of formulated my own options trading framework that has proven to be successful over the last several years. And now I'm just looking to teach others. So if you do like the information that you hear in this video, please join us in the Trade to Freedom community. The link is in the description below. Not only will you get an entire course on my options framework, but you'll also see my trades in real time as soon as I make them. But without further ado, let's get down to business. Options trading 101. So with options, it's all about 100. Options are contracts that allow you to buy or sell 100 shares of a stock at a specific price, which is called the strike price, by a specific date, which is called your expiration date. So every options contract is worth 100 shares. And by opening an options contract, you are predicting stock movement and profit if you are correct. Okay, so most people, if they don't know anything else about options, they know about puts and calls. They know that you will buy a put if you think that the stock is going down, and you will buy a call if you think that the stock is going up. So puts and calls are the foundation of options. And you can be a buyer of options or you can be a seller of options. All right, the buyer is considered to be long on the shares, and the buyer has the right to buy or sell the stock. And the seller is considered to be short on the shares and is obligated to buy or sell based on the buyer's choice. Now, there are pros and cons to being an option buyer, and there's pros and cons to being an option seller. I personally, 99% of the time, am an option seller. And we'll go into detail much more later in the video on why that is. When the option is open, the buyer pays the seller money, which is known as the premium. The premium is paid up front and is kept by the seller regardless of the option's outcome. Okay, so that's the first thing to note. If you are buying an option, then you will be paying money up front. And if you are selling an option, you will be receiving money up front. And the premium is the option's per share value. So if you remember from the first slide, every options contract is worth 100 shares. So an example is if an option is sold for $1.15, that means the seller receives $115 up front because that $1.15 times 100 would be $115 total. And down here we have an options chain. So this is where you get to see options prices at. And I have Tesla pulled up, ticker symbol TSLA. And if we were to come over to the put side, so the puts are always on the right and calls are always on the left, and that's going to be for any broker that you choose. But if we come over to the put side, if we look at these two columns here, we see bid and we see ask. So the bid is how much a buyer is willing to pay, and the ask is the sticker price that the seller is trying to sell for. And so typically when you open a trade, the price you get is somewhere between the bid and ask spread. So if we were to come down here, we can see that Tesla stock price is currently $259. And let's say we wanted to sell a put at $235, we would receive anywhere between $345 to $355 right here, right now for opening that trade. And then vice versa, if we were to buy a $235 put, we will be paying anywhere between $345 to $355 for opening that trade. So if we do a quick recap, options are contracts to buy or sell stocks at a set price by a specific date. And the set price is our strike price and the date is our expiration date. All right. Buyers predict stock movement while sellers have obligations. And lastly, premium is the upfront payment from the buyer to the seller. So now that we have that foundation, let's move forward. So firstly, let's talk about buying options. So with buying options, you have the chance for high profits, but you have a low probability of profit compared to selling options. So buying options can be very speculative in nature, and it's almost somewhat like gambling in some sorts. Or at least it is how most people use buying options. And with buying options, you can put in a small amount of money and possibly see a home run hit. However, the chances of that happening are very slim. So with buying calls, you make money as the stock goes up, and you're able to use leverage because it costs much less than it would if you were to buy 100 shares of said stock. And so that is the appeal of buying calls. So let's say you have a stock that is currently $100. Well, in order to buy 100 shares of that stock, you would need $10,000. Whereas with calls, you can maybe buy a call for $1,000. So you're still getting the power of 100 shares, but at 10 times less of the cost. And lastly, time works against you, causing low probability of profit. When you buy a call, you need for the stock price to rise above your strike price by the expiration date. And so because time will always keep continuing on, the closer to your expiration date that you get and that stock price has not risen above your strike price makes your chances of profit lower. And then on the opposite end, we have buying puts. So with buying puts, you make money as the stock goes down. It costs less than shorting 100 shares, and time again works against you, causing a low probability of profit. So same exact example, if we have a stock that is currently trading for $100 and you buy a put at $90, you need for the stock's price to go lower than that $90 strike in order to make money. And you need that to happen before the expiration date. So when you're buying puts, you have the right to sell 100 shares at the strike price. So if we use the example that we just did, if there's a stock at $100 and you set your strike price to $90 and the stock drops, well, you have the right to sell up here, even though the stock price is down here. And that's where your profit comes in. And then on the opposite end, buying calls, you have the right to buy 100 shares at the strike price. So if a stock is $100 and you buy a call at 110 and then the stock price rises up above, then you still have the right to buy the shares at that $110 strike price, even though the stock price is way up here. And then you could obviously immediately sell if you wanted to. And so buying a call is very similar to buying a coupon. And so here's the analogy. If you were to buy a coupon, first thing you would do is you would pay for the coupon, which would be the premium that lets you purchase an item at a set discount price. And then secondly, the discount price, that would be the strike price, the price you buy the item for with the coupon. And then third, expiration date. Well, all coupons typically expire. So just like options, you will have an expiration date where the coupon or the contract becomes invalid. And number four, if the item's price goes up, your coupon lets you buy at the discount. And then five, your risk, if the item's price doesn't go up, you don't use the coupon and you lose only what you paid for the coupon. And that is really exactly how buying a call would work. But now let's look at buying a put. So buying a put is very similar to buying insurance on something. Assume you're buying insurance on your car. All right, the first thing you would do is you would pay for the insurance. So you pay a premium for the right to sell at a set price if things go wrong. In the analogy of a car, you're paying that premium every month just in case you get into a car accident that the insurance company will cover the value of your car. But with options, it's the value of the stock. So number two, we have a guaranteed value. The strike price is the value you're insured for, even if the actual value drops. So in the comparison to a car, you would be valued at whatever your car is worth, even if you were to get into an accident and then the car is worth nothing anymore. Number three, expiration date. Insurance has a time limit, just like an options expiration. That's self-explanatory. Number four, protection. If the value drops, you're covered and can claim the difference as a profit. And number five, risk. If nothing changes, you lose only the premium like unused insurance. So with your car insurance, you likely pay a premium every single month, but most months you don't get into a car accident. So the most that you lose, quote unquote, is that premium that you paid the insurance provider. And that is exactly how buying a put works. You quite literally are buying insurance on a stock. Now here's an example of buying a call. Let's say that ABC stock is currently trading at $100. Well, David buys a 30-day call at a $120 strike, paying a $200 premium. If ABC stock rises above 120, the trade is profitable. If not, he loses the $200 premium. And here's a quick visualization of how that would look. All right, so we said we have ABC stock and David bought a call at $120. Okay, so $120 strike, and the stock is currently trading for $100. And he paid $200 to get into this trade. So here's how this will work. The stock is currently trading down here. He needs it to move up past this $120 strike in order to make money. And as long as it does that, he could make a ton of money. However, let's say that the stock price stays down here throughout the term of the options contract. Well, he's pretty much going to lose the majority of that $200 that he paid in order to get into the trade. Now let's head over to the Thinkorswim platform and see how a real trade will work out. So now I have the options chain pulled up and I typed in TSLA, which is Tesla's ticker symbol. And I'm looking at dates about 30 days out from now. So if I wanted to buy a call, I would come over to this left side. We can see that calls are over here and the stock price is currently $261. And let's say I wanted to buy a call for $280. Well, we can see here at the bid and ask spread, I'll be paying anywhere between $855 and $865 for opening this trade. So let's go ahead and analyze the trade to see how much money we could possibly make or lose on this trade. So I'll hit buy, single, and then I will go ahead and analyze this trade. So what I want you to do is pay attention to this blue number down here. So the blue number represents the amount of money we will make or lose at the expiration of the trade. And down here on the horizontal line, we have Tesla's stock price. And then over here on the vertical column, we have how much money we will make or lose. And so we had a strike of $280. So you can see right here, I'm hovering around 280, and that is exactly where we will start to make money. But as we go up, you can see how the blue number down there is going up more and more as the stock price goes up. So right here, it's currently set at $320. So we can see if that happened, I would make $3,164 from that trade. And then theoretically, the stock price could go to infinity. So it could, go all the way up here to like $600 and we'll make almost $30,000 from that trade. Now, obviously, the likelihood of that happening in that 30-day period is very slim. However, you never say never. But if we scroll back down to below the $280 strike, you can see that $865 that I paid to get into the trade, that's how much we will lose because the contract will be worth nothing at the expiration date. But now let's analyze buying a put. So I'll come back over to the options chain. And now I want to, let's say, buy a put at $250. So I'll go ahead, buy, hit single, and let's go ahead and analyze the trade. All right, so now it's pretty much the same thing in reverse. So we still have Tesla's stock price down here. We have the amount of money that we can make on this vertical column, and pay attention to the blue number. And as Tesla's stock price goes down, we end up making more and more money. All right, so let's say it went down to $180. We'll make about $6,000 off that trade. However, if the stock price stays above the 250 strike, then we will lose the amount of money that we paid for the trade, which in this case was $980. All right, so what are the pros of buying options? Well, you get unlimited upside potential. As mentioned before, you could buy a call or buy a put for a very small amount of money, and it could end up being worth several thousands at the end of the trade. And secondly, the low cost of entry. So the further out strike price that you pick, the less and less that the options contract is going to cost. So if Tesla is trading for $250, the strike of $240 is going to cost much more than the strike of, let's say, $200. And lastly, the most you can lose in any buying options trade is the amount of premium that you paid to enter into the trade in the first place. So to me personally, I think that is probably the best thing about buying options is you already know upfront what the worst that could happen. And now let's take a look at what are the cons of buying options. So the first thing is time works against you. So the closer and closer you get to the expiration date, and your stock has not gone in the money, the less and less that contract is going to be valued. And if it still hasn't passed the point that you need by the expiration date, the contract is going to be worth $0. Number two is you need the stock price to move in a specific direction in order to make money. And we'll get into selling options in a little bit, but with selling options, you can make money no matter which direction that the stock goes in. And lastly, probability of profit is much lower than selling options. All right, so those are the fundamentals of buying options. Now let's head over to selling options. So when you sell puts, you make money if the stock goes up, you make money if the stock doesn't move at all, and you make money if the stock goes down just a small amount. And here is how that looks. All right, so let's assume we have David again, and he is selling puts on ABC stock that is currently trading at $100, and he goes ahead and sells a put at $90. All right, so he selects a $90 strike, and for doing so, he receives $200 in premium. Well, here's what happens throughout the trade. If the stock price, let's assume it's trading right here, right now, if the stock price goes up, he makes his money. If the stock price pretty much stays the same, he makes money. If the stock price goes down, as long as it stays above that $90 threshold, he makes money and goes about his day. All right. So that's the great thing about selling puts. You can make money no matter which direction the stock price goes. But if the stock price were to drop below the strike price of $90, now David has to buy 100 shares of that stock at the strike price that he selected. And that is how selling a put will work. Now, when you sell calls, you make money if the stock price goes down, you make money if the stock doesn't move at all, and you make money if it goes up just a small amount. And so just like the puts, let me show you a visualization of how this would work. Now, again, we have David and he wants to sell calls on a stock. Now, typically when you sell calls, you sell it on a company that you already own. And that is what's called a covered call. And so this is how that will work. And so let's assume that David bought shares of ABC stock at $100. But now that he owns the shares, he wants to sell covered calls at $110. So this is how that will look. So we're going to sell a strike of $110, and the stock price is currently down here at $100. So if the stock price were to go down, he would make money off of the contracts. If the stock price were to stay the same, he would make money off the options contracts. And if the stock price were to go up all the way to $10, then he would make money on the options contract. Now, if the stock price were to rise above the $110 strike by the end of the expiration date, then he still makes money off of the options contracts. However, now he is forced to sell his shares of ABC stock at the price that he agreed to, which is $110. And selling covered calls is considered to be one of the safest option strategies that exist. And selling puts is very much like selling insurance. All right, so the first step you would do if you were to sell insurance, you would receive a premium. So you get paid upfront premium for agreeing to buy the stock at a set price if it drops. So it's no different than your car insurance provider. You're paying them that upfront premium every single month, and they are taking on the risk, quote unquote, of buying the car if you were to get into an accident. Just in this case, it's a stock instead of a car. Number two, the obligation price. That is the strike price, the price you're willing to buy the stock if needed. Thirdly, you have the expiration date. Your obligation to buy lasts only until the option expires, just like insurance contracts have expiration dates as well. Number four, profit potential. If the stock stays above the strike price, you keep the premium as profit with no further action needed. And number five, risk. If the stock falls below the strike price, you must buy it. And the proper way to sell puts would be to sell puts on a stock that you already want to own anyway. So therefore, if the stock price were to drop and you have to buy the shares, well, it was a stock that you already wanted in the first place, and now you're getting it at a discounted price compared to what it was previously. All right, so here's that example again. If ABC stock is currently $100, David sells a 30-day put at a $90 strike, receiving $200 in premium immediately. If ABC stock stays above the $90 strike, the trade is profitable and we go about our day. If not, he has to purchase 100 shares of ABC stock at $90, but he still keeps the premium that he received. Now let's head over to Thinkorswim so we can see how a real trade would look. So here we are at the options chain, and now I have Palantir pulled up, ticker symbol PLTR. We can see that it's currently trading at $44, and I have put up the options chain expiration date of 30 days out from now, and now we want to sell a put. So let's come over here. Let's assume that we want to sell a put for around $40. So we'll come over to the $40 strike, and we can see that the bid and ask spread is between 1.55 and 1.58, which means we will receive $155 to $158 immediately upon selling a put if we were to do it right here, right now. So let's go ahead and analyze this trade. So I'll go ahead, right click, hit sell, single, and then we will analyze. All right, so again, paying attention to this number, this blue number down here at the bottom left. So as long as the stock price stays above $40, we just keep that $155 that were received for selling the put. However, if the stock price were to drop, you can see that it will show you a negative value here. However, the smart thing to do is just go ahead and buy the shares at the $40. And since you already believe that it is a great company, just wait for it to rebound or go ahead and sell covered calls. So let's go ahead and analyze a covered call. All right, so we're back here at the options chain, and now let's assume that we own the shares and we would be comfortable selling the shares, let's say at $50. So we can come over to the $50 strike and we'll go ahead, hit the sell, single, and we can see that we will receive anywhere between $167 and $169 for selling this covered call. So let's go ahead and analyze the trade. So we can see if the stock price stays anywhere below the $50 strike, we just keep that $167 that we received. However, if the stock were to go above the $50, you can see there at the bottom left again, it's showing a negative value. However, you can just sell your shares at that price and not lose any money. And that is why it's called a covered call, because you already have the shares in order to cover the trade. Now, however, if you just sell what's called a naked call, so if you're just selling a call on a company that you don't own, so let's assume that we don't own the shares of Palantir and we sold this $50 call, well, yes, as the stock price goes up, you're going to lose the amount of money that you see there at the bottom left. However, if you already own the shares, then you don't even need to worry about that. And if you're going to trade options, you need to know about the options Greeks. So the options Greeks consist of delta, gamma, theta, vega, and rho, and they all collectively affect the pricing of an options contract, aka the premium. And while I could further explain this more in other videos, there's only one of these that I really pay attention to, and that is the delta. You can see by definition, delta is the sensitivity to stock price changes. However, delta also shows the probability of the event occurring. So let's head back over to Thinkorswim so I can show you exactly what I'm talking about. So we have Tesla's options chain pulled up, and if we come over to this column here, we can see it says delta. So if we scroll down, you can see different numbers like this $235 strike has a delta of 0.20. Well, that is simply saying that there is a 20% chance that Tesla's stock price drops to $235 by the expiration date. Okay, same thing if we go up to this $220 strike, has a delta of 0.11. So it's saying that there is an 11% chance that Tesla's stock price drops from 262 where it's at now down to 220 within 30 days. And so you can use those probabilities in order to give you an edge when you're trading. And I always take a look at deltas before I place any single trade. And then very unrelated, but if we come over to the next column, you can see it says volume, and that just shows the amount of contracts that were traded today. So if we come over to this $220 strike, we can see that there was 167 contracts traded for this strike here today. But if we head over to this column right here, you can see it says open interest. And also at the $220 strike, you can see that there are 1,768 contracts that are still open as of right now. And you can use that to kind of get a hint of what other people are doing. So if we come down to this $250 strike, we can see that there are 5,118 contracts open for that strike. So there are a lot of people that are trading that strike. And you can use that information to better help you with your trades. So what are the pros of selling options? Well, one, time decay works in your favor. So as stated before, when you sell a put or you sell a call, you receive the premium up front right then and there. And as time goes on and we get closer to the expiration date of the contract is worth less and less and less, meaning you can pay back much less than what you received. Or you can even just allow the contract to expire worthless and keep 100% of the money that you received. Secondly is immediate payment. You get paid as soon as you open up the trade. Thirdly is the flexibility that you get. You can profit even if the stock moves in the wrong direction. Number 4 is the disciplined approach for steady returns. So with selling options, you can continue to do it over and over and over again. So in the previous example, we used the Palantir and we sold puts at $40 and we did contracts that are 30 days out. Well, what if Palantir never drops to under $40 again? Well, you can theoretically just continue to sell puts over and over and over and over and over again for steady, reliable income. And in my community, those are the type of people that I'm really focusing on. People that are looking for steady, reliable income, people that are looking to supplement their 9-to-5 income, or even some people that are looking just to totally replace it. And selling options can be very reliable when it comes to how much money you're going to make, whereas buying options, you really don't know. But I've been able to make multiple 6 figures per year with 99% of my trades being selling strategies. All right, and then lastly, the downside recourse. So when you sell a put, say the stock price were to drop and then you're assigned the shares, you could just wait around for the stock price to go back up and then sell the shares again. Or even better, do the covered call that we just spoke about. And what are the cons of selling options? Well, you have potential for missed upside. So an example of this would be if we were to sell that put on Palantir that we just did at $40 and we collected that $100 and something premium, well, that is all that we can get. So what if Palantir were to go up to $100? Well, we missed out on all those other potential gains because we capped our max profit at what we received to open the trade. Whereas people who bought a call would make money as the stock price continues to go up. And then number 2 is over leveraging. So this is something you really do not want to do. There are no free lunches in the stock market. So a lot of people will see the premium that they can receive and they'll sell like 100 contracts. Well, remember, when you're selling, you do have an obligation to buy or sell. So if you were to sell a put at $40, you do have an obligation to buy those shares at $40 if the stock price drops. So you would only want to sell the amount of contracts that you can afford. And a good reason that I love selling options is you essentially get paid while you wait. Selling options is my favorite strategy due to the high probability of profit and the consistent income. Selling options is basically my money printer. So, I put my waiting paper in and I get green paper out. There's absolutely no reason that anybody shouldn't be involved with trading options. But that's it for this video, people. I hope that you found this information extremely helpful. I hope that you decide to start trading. But if you would like to learn more from me, if you would like to get my exact trades as soon as I answer them and see my entire options framework, please come join the Trade to Freedom community. The link is in the description below. It's filled with community members that are all looking to generate consistent and reliable income on a regular basis. And I'm assuming you have the same goals. But if not, I'll see you guys in the next video. Peace!